Welcome to the Pro Ticker Deep Dive. Today, we are diving right into the heart of the casino industry. We're looking at this collision that's happening right now in late 2025.
It's a really fascinating moment.
It is. It's not just about gambling anymore. This is digital disruption versus legacy real estate.
Hmm.
So our mission today is to really analyze these two competing stories.
You've got the legacy guys on one side and the high-growth digital natives on the other.
And we're going to break down the latest data to figure it out.
It's such a critical time because the whole sector is, well, it's fractured. You have a company like DraftKings, which is pure play digital, and they're racing for market share, but they've just hit some serious friction.
Right. And then you have the giants, MGM resorts.
Exactly. They're trying to manage these massive physical assets, these casinos, while also trying to build a credible digital business on the side.
Which leads us to the big question that I think every investor is wrestling with right now.
Hmm.
Are casino stocks in a genuine comeback story, a sustainable one, or are we looking at a classic value trap?
Yeah, something that looks cheap but has these, deep structural problems just hiding under the surface.
So let's frame that choice for you. On one hand, you've got DraftKings. It's the high-risk, high-growth, really volatile play.
And on the other, you have MGM Resorts, which is a much more diversified bet. They're banking on global asset recovery and this kind of hybrid future.
And you just can't ignore the macro environment here. I mean, this market is not standing still.
Not at all. The data we're looking at shows the global online gambling market is set to just explode. It's going from around $118 billion to over $191 billion by 2029.
Wow.
That's a 10.2% compound annual growth rate.
$191 billion by 2029. That's not just growth. That's a total replatforming of an entire industry.
It is, and sports betting is the engine behind all of this. It now commands almost half, nearly 48% of that entire global online market in 2025.
Which really explains why a company like DraftKings can be so valuable, even with all its recent volatility. Okay, so let's unpack those structural forces. What's actually powering this dramatic shift online?
You can really boil it down to three forces that are all hitting at the same time. First is regulatory liberalization.
Especially here in North America.
For sure. Second is just faster digital adoption from consumers. Everyone's used to a mobile-first world now. And third is just relentless tech innovation, which we'll get into. It's making the digital experience so much better.
Give us some scale on this growth.
Okay, so the total global market, physical and online, is projected to hit almost $450 billion this year.
Huge.
But the online part is growing so much faster, it's expected to reach $286 billion by 2035. That means the digital side is going to nearly triple from where it is today.
So it's completely outpacing the old brick-and-mortar growth.
By a mile. That's where the premium is moving.
And that North American sports betting boom is, it's the poster child for this. What does that growth actually look like in terms of how people are betting?
The North American market alone was valued at $24.5 billion in 2025. But here's the crucial detail, the behavioral shift.
Okay.
It's not just that people are betting, it's how. Live in-play betting, where you bet moment by moment during the game, that now accounts for more than 50% of all online betting volume.
Which requires a completely different tech stack.
A completely different approach to risk management than the old pregame wagers.
And meanwhile, the physical side of the business, it's really a tale of two cities, isn't it? Which is so important for a player like MGM.
Exactly. Domestically, you have Las Vegas, which had a pretty soft summer in 2025.
After all the hype from Formula One.
Right. Visitation was down, gaming revenue was softer.
Yeah.
The whole recovery story there really depends on convention bookings coming back to fill those midweek rooms.
But then you look overseas.
And MGM China is on fire. They reported a remarkable Q3. Net revenues were up 17% year over year to $1.1 billion. The whole Macau industry is recovering to like 88% of 2019 levels.
And what's driving that?
It's being driven by a surge of wealthy mainland Chinese visitors. So for MGM, a big part of their story relies on, geopolitical stability and Chinese wealth.
Okay, let's pivot now to the pure digital play, DraftKings. Let's get into their Q3 numbers. We saw growth, but that guidance reduction, it absolutely hammered the stock. What happened?
Well, the top line, it looked okay at first glance, but the growth rate was pretty disappointing for a growth stock. They reported $1.14 billion in revenue, but that was only a 4.4% year-over-year increase. And their core sportsbook revenue actually missed what analysts were expecting.
So what was the saving grace?
It was their iGaming revenue. The digital casino side, that surged almost 25%, which shows they were having success cross-selling to their users.
But the real story, the friction you mentioned, was that huge financial headwind. It wasn't about a lack of users. It was. Bettors just won too much.
It's the bizarre part of the story. Management said there was a $300 million revenue impact from what they called customer-friendly sports outcomes.
In other words, the house lost.
The house got steamrolled by a run of highly profitable results for the public.
So is this a fundamental flaw in their risk modeling, or is it just a blip, a black swan event we can ignore? Because $300 million is a huge number to blame on just bad luck.
That is the million-dollar, or I guess the $300 million question the street is asking.
Right.
I mean, a few upsets can hit a quarter, sure.
Yeah.
But the really sophisticated operators, they hedge these things. The size of this miss suggests either it was a true black swan event, just terrible luck, or that their risk modeling algorithms, which are so crucial for live betting, just aren't as good as their competitors, like FanDuel.
And the result was a complete reset.
A severe reset. They slashed their 2025 revenue guidance, and they cut their adjusted EBITDA forecast from a high of $900 million all the way down to a range of $450 to $550 million.
And that just destroyed investor confidence in their forecasting.
Completely.
So facing that, DraftKings makes this big strategic pivot. They're launching DraftKings Predictions. This feels like an attempt to find a workaround for states where betting is still banned.
It's a critical, very high-stakes move. They're launching a new platform using federally regulated contracts on sports events. The key difference is they can launch this in all 50 states.
So they're targeting regions where traditional online sports betting is still illegal?
Exactly. So instead of betting on the game, you're essentially buying a contract on an outcome, which falls under a totally different regulatory structure.
That's clever.
It is. It's an innovative way to unlock a huge market that's just been sitting there. Management thinks this could be a significant incremental opportunity.
What's the potential size of that?
They're projecting it could unlock between $500 million and $1 billion in addressable market. It's a huge bet, but it's a bet on regulatory interpretation.
But the risks here must be intense.
Oh, absolutely. I mean, even though DKNG is #1 by volume in 25 states, the competition with FanDuel is just relentless. FanDuel often has better odds, which forces DraftKings to sacrifice their own margins.
And then there are taxes.
Yes. Add on that unavoidable margin pressure from rising gaming taxes in key states like New York and Pennsylvania. And of course, the regulatory pushback on these new prediction markets is already starting.
And the stock chart reflects all of this. It's trading almost 40% below its 52-week high, and it's below its 50-day moving average.
Which, for anyone tracking technicals, is a pretty clear bearish signal. It shows the stock's momentum has just fundamentally broken down after that guidance shock.
Okay, so if the digital pure play is hitting walls, let's look at their legacy rival, MGM. They promise this diversified approach, but how are they actually handling those physical headwinds we talked about?
MGM's a totally different story. Their consolidated Q3 revenue was $4.3 billion, but you have to look at what's inside that number.
The composition is everything.
It is, and the challenge is clear. Their Las Vegas Strip operations actually declined 7%. That softness hit their occupancy rates, it hit their average room rates. The core asset is facing some serious headwinds.
Wait, so if the Strip fell 7%, isn't the Macau story just, but still, that core Las Vegas business, property-level earnings, the EBITDA, fell a staggering 18%.
And we should probably pause on that term, EBITDA.
Right, because it's not the same as EBITDA.
Exactly. For a company like MGM that leases its buildings from a REIT, EBITDA is critical because it strips out those massive rent payments. So when Strip EBITDA drops 18%, it means the actual operational profit of the casino before paying the landlord is getting squeezed hard.
So how is management responding?
Cost containment. They're cutting headcount by 7%, and they're raising those resort fees by $3 to $8 a night.
Which nobody likes, but it brings in cash.
It's unpopular, but it's estimated to add about $70 million in revenue. It's a necessary move to stabilize margins.
But we have to address the skepticism. Goldman Sachs put a sell rating on MGM, and they cited a very specific liability. Why is the debt load such a problem here?
It's all about the structure. It's this significant lease burden. We're talking about $17.1 billion in total debt and lease liabilities. When you sell and lease back your properties, you get cash up front. But you're now locked into massive fixed rent payments.
No matter what the economy is doing.
Doesn't matter if Vegas occupancy is 95% or 89%, you still have to pay the rent, and that huge fixed cost really limits their financial flexibility. They have huge projects looming, like the multi-billion-dollar MGM Osaka that won't even open until 2030,
So the debt makes it harder to fund growth.
or even do share buybacks.
And looking at their chart, MGM is also trading below its 50-day moving average, like DraftKings, but the weakness isn't quite as pronounced.
Right, because of that diversified revenue we just dissected.
This all brings us back to the broader thesis, doesn't it? The real fight here is about who can best leverage technology. And what's so interesting is how tech is changing the actual business model of a casino from the ground up.
For sure. And AI is no longer a buzzword here. It's a core differentiator. AI-driven personalization can lift how long a player stays in the app by almost 30% and revenue per user by almost 20%.
So how does that work in practice?
Okay, so machine learning models will instantly analyze your behavior, how fast you bet, your risk tolerance, where you're clicking in the app, and in milliseconds, it uses that data to change the lobby and personalize the bonuses you see.
So if I'm a high-stakes blackjack player,
The app instantly puts blackjack front and center for you and offers you a specific high roller bonus. It creates this digital stickiness that the old generic experience could never match.
and what about trust? That's always been the big hurdle for online gaming. How does something like blockchain solve that?
Trust is everything. Blockchain allows for provably fair gaming, which is cutting down on customer disputes over rigged results by about 65%.
That's a huge number.
It is. And for the operators, smart contracts mean instant, borderless payouts. It eliminates chargeback risk and just makes withdrawing your money faster and easier. It removes that human element of doubt.
Okay, but what about the atmosphere gap? The knock against online casinos has always been that it doesn't feel like you're in a real casino.
Well, VR and AR are closing that gap very quickly. VR casinos now let you step into these photorealistic halls. You can sit at a poker table with other avatars. You can chat with voice-activated dealers.
And AR takes it a step further.
Augmented reality projects the game, like a roulette wheel, right onto your living room floor. It blends the digital world with your physical space.
So when you put it all together, AI, blockchain, VR, the whole model is flipping.
The transition is so clear. The industry is moving from a venue-centric, property-dependent model to a technology-centric, data-driven model. Your most valuable asset is shifting from square footage to unique user data.
Okay, let's bring it all home for our listener. Let's summarize the final investment decision here. What are the strongest bullish nuggets for each company?
For DraftKings, the bull case is all about the execution on the predictions markets. That could materially open up new revenue in locked states. And their iGaming growth proves they know how to monetize users deeply. If they fix their risk models, the path to profitability supports a much higher valuation.
And for MGM?
For MGM, the bull case is diversification. BetMGM is a success story, is generating cash now. The MGM China recovery gives you that non-correlated leverage to Asian travel, and they're expecting Las Vegas to stabilize as conventions return.
Now let's flip the coin. The key bearish risks for DraftKings.
The margin pressure from rising taxes is structural. It's not going away. The regulatory risk around predictions is very real. And until they deliver a few clean quarters, there are serious questions about management's forecasting credibility after that big miss.
And for MGM, the bear case?
It's that anchor of debt and leases $17.1 billion, which just limits their flexibility. Those huge CapEx cycles are looming. And we can't forget that the core Las Vegas business is still very sensitive to consumer spending.
So my final thought here is this isn't a simple comeback story. It feels more like a fundamental industry reshuffling.
That's a great way to put it. You have to pick your conviction. If you're bullish on the long-term digitalization of gaming, then maybe DraftKings at $29 offers a good risk-reward, but you're betting entirely on their tech execution.
And the alternative.
If you're betting on hard assets, international recovery, and a more measured, diversified story, then MGM at $31 deserves a look. But you have to fully trust their margin story and accept the limits that come with all that debt.
It really feels like the choice for you, the listener, comes down to one single question. 5 years from now, which asset will command the higher premium in this new gaming world? Is it the real estate, the steel and glass on the Vegas Strip represented by MGM? Or is it the data, the ones and zeros from DraftKings that show exactly how every player bets?
That is the ultimate divergence in value creation.
Yeah.
Your decision really has to reflect your conviction in that structural shift and, of course, your own tolerance for risk.
That's our deep dive into the cross-currents impacting casino stocks right now. See you all in the next Pro Ticker Deep Dive.